Welcome back to the Consulting Mind. Today we're going to talk about bond market. Why the bond market matters a lot to equity market. And in this episode, I would like to clarify some misunderstanding or some myth on the followings like why should I care about those 1 to 2% return in the bond market? Since I'm not a low risk investor, why do I have to bother about the bond? I only trade stock, not bonds, so I should not and need not pay attention to bond market, which is irrelevant. And I don't think that understanding the bond market can help increasing my winning chance in equity. Is that really like that? I'm going to explain to you in details in the following sections. Hope you enjoy. So let's start with some impressions up first. Very often, we might have the impression towards bond that it is not relevant to me as an equity investor, or bond is just a low risk, low return stuff. So it is really not relevant to me. But then let's really think about who are investing in the bond, who are the bond investor. The answer is most of them is the institutional investor. And who are institutional investor? They might include the insurance company, the pension fund, hedge fund, bank, mutual fund, or some endowment fund, university, private equity, or other investment advisors. So you can see all of them, or majority of them, are professional investor with the features of first, they have a lot of research and analytical resource expertise, such that they really knew a lot about the market than the average person. And then what happens next is that they trade the bond with the information and the research result that they have. And finally, the bond price and the bond movement reflected in the bond yield, reflected by the bond yield, is the outcome. What outcome? The traded outcome of this type of professional and institutional investor. So the bond price result really matters a lot because it incorporates and reflects those consensus, those belief, those research results done by those professional investors, which will be shown into the yield curve that you and I can access in the Treasury website. So this is why bond really matters a lot. Just you can see from who are investing those material, you will have some understanding on that. And then, in order to give you a more clear understanding and impression of how big is the US bond market, I'm going to give you two figures. The first one is US bond market is about 41 trillion US dollar worth. And on the contrary, the US New York Stock Exchange is only about 30 trillion dollars. The number is just an estimated and a round number. Of course, the market value change day from day to day, so does the two figures. But here just to give you a very rough understanding of how large it is. And indeed, it is very large. And then let's move on to talk about the daily treasury yield, which you can access through the US Department of the Treasury. This is one of the most important and crucial indicator that you as an investor will have to monitor on a day-to-day basis if you want to enhance your investment winning chance. No matter you are investing in bond, equity, commodity, or even currency, it's just way too important. And what these figures can tell us is that it gives us a understanding of how the market is going on. For example, when you look at the 10-year yield, what it can tell us is the market expectation and the market consensus towards the future inflation outlook. Like for example, you can see the latest 10-year yield will be about 115 basis point for the 10-year yield, and which is about 20 basis point more comparing with the beginning of this year, which means that during this about 10 days, the market has a higher expectation towards the inflation outlook of the US. And then you may wonder and you may question, oh, why 10 years? Why not 12 years? Why not 30 years? That's another story. But just at this moment, let's bear in mind, 10-year yield will be the market consensus of the US inflation outlook, and we can talk about why later in more details. And the next point is the yield spread. What does yield spread mean? It means that usually we will take two yield like 10-year and 2-year and calculate the difference, and this is what we call the yield spread. For example, the 10-year yield will be 115 basis point, right? And then the 2-year yield will be about 14 basis point. The difference of the two will be the yield spread. So what's that for? It is just a economic health check. Normally, the yield spread, first of all, it should be positive, right? And then there should be a spectrum about the difference. It could be larger, it could be smaller from time to time. And very often we expect a certain width of the spread among the two figures, because let's imagine, let's talk about the rationale behind. First of all, why 10-year yield should be higher, right? Why 10-year yield should be higher? Because 10-year, the longer the year, the risk will be higher, right? Because it will involve more uncertainty as the year goes by. We don't know about whether or not we can sustain our investment rate of return, right? But on the other hand, when the maturity, when the duration is shorter, like 2 years or 2 months, I, as an investor, will naturally demand less return because of the inherent risk is lower, right? So it just makes sense to have a positive spread most of the time. And then we can move on to the next point. So why? Sometimes there would be an inverted yield. So what is inverted yield? It means that the shorter duration of the bond yield is actually higher than those in longer duration. Let's say the 2-month yield is higher than 10-year yield, which could happen. And the rationale behind is that there are some problem happen in the market such that it become malfunction, and it will be a very strong risk indication of how the market will go into the futures. So now let's move on to elaborate more on the risk concept. I think most of you should already have been heard of the word risk on and off from time to time in different newspaper or news reporting. I think you will understand that when the news said that the market is risk on now, it means that the market sentiment is going optimistic, that they will tend to buy more equity than bond. They will tend to shift the money from the equity market to the bond market. And when the opposite happens, when they are saying that the market is risk off now, it means that the money go to bond instead from the equity market. So the logic and the rationale behind is that you can think of the bond market as a parking area where when the market feel like that there are some uncertainty or some risk that will be happen in the future, they tend to be more conservative. And as a risk management approach, they will put some of their money, some proportion of their money from equity to bond as a parking fund to earn some interest, and until the situation become more clear to them. So you can think of equity and bond is kind of a competition relationship where they will have to compete for the money. Let's say if I'm a fund manager running about a $100 billion fund, I will have to decide how many percent of the fund will go to bond and how many percent of them will go to equity. But it is just an analogy, not exactly competition, because certain percent of the money will have to be invested in bond anyway due to the investment mandate. But that's another issue. You can, for simplification, you can think of their kind of competition in the market. So let's move on to the next point. The bond yield will actually affect the central bank monetary policy, because think about what is the mandate and the objective of central bank. Usually they will have two mandate. The first one is to maintain a stable inflation, and the second one will be to maximize or stabilize the unemployment rate. As mentioned before, the 10-year treasury yield is a very strong and predictive powerful indication of the future inflation. So actually not only you and me, but also the central bank will actively monitor the trend of the 10-year yield such that they will know how the market think about the future inflation in order to adjust and amend their monetary policy accordingly. And the other one is unemployment rates. As mentioned before, The yield spread or the yield curve pattern is a very strong indication of the macroeconomic condition, whether or not there is a liquidity issue, whether or not it reflects the market might have some potential risk. It will also be a key factor when the central bank is to evaluate the coming economic condition, which will very much closely related to the unemployment rate. So now I think we can do a very quick wrap up here. Why do equity investors like you and I have to bother about the bond market movement is that first, bond market is a key market where the institutional investor use their money to bet, to interpret on the market condition, which is subsequently reflected into the bond price movement. And secondly, it is a very powerful indication of the future inflation outlook and the relevant risk. Thirdly, it will be also an indication or a prediction for the central bank policy because they will also refer to the inflation which is reflected by the 10-year yield subsequently. I hope this episode will help you to gain a more accurate and a more broadened perspective towards bond. And I hope by understanding this element, it will help you to enhance your investment return or winning chance subsequently. Thanks for watching. See you soon.